For those dialing in online, welcome to OCBC Wealth Insights. I hope you're feeling a bit more refreshed and awakened now. Before we start our program, I will just briefly introduce the rules of the game this morning. As you can see behind me, there are 4 podiums. And what we're going to do is we're going to do a presidential debate style for your portfolio. We'll invite 4 speakers, which I will introduce later, and each of them will represent one asset class. We have global equities, Asian equities, fixed income, and alternatives like gold. Now, what the speakers will do is that they'll try their best to convince people, all of you, that their asset class is the best. Round 1, they are given 3 minutes. And after that, you all will be able to vote for your favorite asset class. Round 2, another 3 minutes. Like any presidential debate, I'll be challenging them. And round 3 will be Q&A, where we will be collecting questions from the crowd, and I'll throw it to them. They have 90 seconds to respond to each question. They'll take maximum of 2 each speaker. And if you see on your table, there are QR code, right? There's a QR code. If you have any question that you would like to ask, do scan the QR. You put in the question, and I'll be looking at the question later on. Now, I would like to introduce the speakers for today. Our first speaker from global equities, we have Stefan, Senior Portfolio Manager from Allianz Global Investor. Can I have the slides? And from JP Morgan, representing Asia Equities, we have Anis, Head of Southeast Asia Funds. And thirdly, for fixed income, very difficult, I tell you. Fixed income, bond, very boring one. I have to search high and low for a fixed income specialist from every contact that we know. And the only person I know that can speak properly is a French guy that we flew in from Singapore, from Janus Henderson. Alexis will be talking about fixed income. And last but not least, Bank of Singapore is OCBC Group company. So with no bias, I must introduce 很隆重的介绍, our Chief Investment Officer, Bank of Singapore, Jean, is with us here as well today. And without further ado, can I invite all 4 speakers to join me on stage? A round of applause.
Nice to meet you. Equities, we're making friends already. Yeah.
Ladies and gentlemen, for the next 45 minutes or so, all 4 of you are not friends.
But we just made friends. He has a speech. Oh my gosh.
I have a little bell here. Once you exceed minute 3, I will do I'll ring a bell to politely ask you to wrap up. All right? So without further ado, I would like to invite Stefan from Allianz Global Investor to start with his 3 minutes on why we should be investing in global equities for 2026. Stefan?
Yes, thank you very much. Nice to be here. I would use the foundation for my arguments. I think there's 2 legs. The first leg is a bit more of a structural one, and that is because global equities provide the best exposure to global growth. Now, with much of the issues in the Middle East, perhaps mostly behind us, and energy prices coming off a little bit, we are quite constructive that we will see a pickup in global economic activity. And for that, I think you need to be invested in global equities. The reason not to just go into some area which has the highest economic growth, for me, is that we've seen in the last 20 years that those companies win that have a globally scalable business model, because they can roll out their service or product instantly across the globe. Where do these companies come from? It's difficult to predict. They shift depending also on the sector, etc. So going with a global equity allocation, I think, is the most prudent thing to do. But then I would be amiss if I didn't also talk about AI today. Clearly, AI has been one of the driving forces in global markets in the last 3 or 4 years. In 2024, we saw the outperformance of the hyperscalers building the infrastructure of the AI environment. But this year, they're kind of lagging. Right now, we see really the staggering outperformance of the whole semiconductor space. But with now almost every taxi driver invested at 3 times leverage in that kind of space, I would be also careful about how that can continue. However, I think the AI topic will stay with us. But the next step will be a diffusion of the AI trade across business models and into the application layer. And here we are talking about sectors, for example, like robotics. And those are globally diversified sectors. For example, you have strong robotics companies in the US, Germany, Japan, also, of course, China. So just going with some very narrow bet, I think it will be difficult for you to capture all these kind of opportunities that the diffusion of the AI trade, the application of AI, really brings forward to the global economy. And here, then going with an allocation to global equities is the most secure way for you to access these kind of return opportunities for your portfolio. So to sum it up, number one, with globally scaled business models dominating market performance in the last 20 years, you should be in global equities in times of positive global economic growth. Reason 2, the AI trade. With AI now moving from the infrastructure investment, from the chips investment, now really into that application phase, into that diffusion trade, again, I think you should be in global equities. And with that, I would rest my case.
Thank you, Stefan. And next we have Anis from JP Morgan Asset Management. Anis, take it away.
Great, thank you so much. Before we do, I do have a bone to pick with you, though. For some reason, we're missing half of Asia in this map, and there's only China, Taiwan, Korea, and Japan. So the first thing I'll say is, amongst all the things we can choose here in Asia Pacific, the fact that we are, from a demographic perspective, the largest part of the world, we can go anywhere, really. We can talk about the deep penetration for some of the financial institutions and really innovative things happening in places like India or Indonesia. I can talk about the fact that the consumer market is going to be massive, and the fact that the largest middle class in the world over the next 10 years will come from this part of the world. I can also talk about, for every single dollar, 70 cents of it comes to AI for hardware here in Asia Pacific, but I won't talk about any of that stuff. I'll talk about the fact that we are home to income here in Asia Pacific. Now, if you look at the graph behind me, what you can see is very, very clearly, we are well-resourced, and we have a deep pool of companies that pay high levels of dividend yield here in Asia Pacific, more than anywhere else in the world combined. So if you're looking at just companies that pay more than 4% dividend yield, you have a massive, massive sort of universe of companies to shop around here in Asia Pacific. And that lends itself quite nicely for investors who want to get a combination of all the fantastic growth opportunities I mentioned earlier, but to balance that out with some income in their portfolio as well. And also, as I mentioned, Asia is not just one block. We've got developing Asia, we've got developed Asia as well. So you get a combination of different styles, different sectors, different regions. So you can have a very, very diversified pool of high income generating assets, in addition to all the cyclical and structural growth themes that we see around the world as well. I would be remiss if I didn't address one of the questions you might have for me head on, which is what's happening around the world and what is that impacting Asia Pacific markets? Now, as everybody knows, with the Iran conflict earlier this year, we saw a bit of an issue here in Asia Pacific where, as we all know, we import quite a lot of oil that comes through the Strait of Hormuz, for instance. Now, as we saw, Asian markets corrected about 8-ish% when that particular situation happened. But look at where we are right now, just to demonstrate the fact that, number one, we have relatively low inflation here in Asia Pacific. Right, so there is a bit of a buffer that we can sort of take from that regard. But I think secondly, if you look at markets outside of, for example, India, every other market in Asia Pacific, maybe a little bit in Hang Seng, is up year to date. So I would say the number one thing to bear in mind is you get a bit of growth, but more crucially in Asia Pacific, this is where you go for income.
Thank you, Anis, for his view on Asia. Alexis, I think we have to bring it up a notch. I think these two guys are still playing it nice. And you have the hard part. Why should I invest in fixed income? Alexis, please take it away.
Thank you very much. First of all, I feel very presidential here. So let me start by saying, my fellow Malaysians, thanks for being here. I've been tasked with an impossible thing today, which is to convince you that fixed income is the most important asset class for this year. Let me start by asking you this. Who here follows the World Cup a little bit? Just a quick show of hands. All right. Who saw the first game of the World Cup? And who was expecting Spain to defeat Cabo Verde by 5-0? Just a quick show of hands. Yeah, that's pretty much everybody. All right. So now let me ask you this very important question. Why did that not happen? Because Cabo Verde had the MVP of the game. They had the best goalie that stopped, I believe it was 27 on-score kicks. So my point is this. Same as Formula One. You can't be the fastest car around the track if you don't have a freaking braking system. That's what I'm bringing you today. This year, last time I was in KL was 6 weeks ago. I was due to do another speech, another presentation. The President of the United States had said in a tweet that night that he was about to obliterate a 5,000-year-old civilization. That was the peak of the Iran conflict. It didn't happen, thankfully, but the lesson is here. Volatility is here to stay, and in order to be able to benefit from the talents and the opportunities within equities, you're going to need a very good braking system. But the other thing that happened this year and that made some clients skeptical is, hey, you know, I had bonds in my portfolio. They didn't really work so well last year during Liberation Day. They also didn't work so well this year during the Iran war, where everybody was worried about inflation and my bonds didn't protect much. I agree with you. This is specifically why we at Janus Henderson, we're focused on the big green square that you see on this, which is securitized assets. We think that today, if you want to have some proper diversification and some proper ability to slow down the machine when volatility hits, you want to be involved in short-end bonds, in short end of the curve, in short duration, and in floating instruments. And that's exactly what we specialize in, and that's where we see all of the opportunities here. And I'll come back on that later on. So with that, I will say one more thing. Don't think about what fixed income can do for your portfolio. Think about what you can do for fixed income. And with that, I'll pass my time.
Thank you. Thank you, Alexis. And now to Jean. Jean, I try to drum up the support for you because you are talking about alternative and gold, and it's not easy. So I've ensured that all the tablecloth and linen in this room is gold in color. But now I will have to pass the stage to you. Jean, why should I invest in alternatives like gold in 2026?
Good morning, everyone. Do you, ladies and gentlemen, wish to allocate to gold as part of your portfolio, to have and to hold from this day forward, for better or worse, for richer or poorer, in sickness and in health, to love and to cherish for the sake of your long-term portfolio for you and your families? Is the answer yes? Thank you very much.
I do.
As with all enduring marriages and relationships, let's not forget the good times just because we're having a bad time. Last 2 years, gold has returned you 27% in 2024, 64.5% in 2025. In 2023, we started the year with gold at 1,825. This year, all-time high was 5,595. How can you not be in love with gold? Just because in the short term we've had some challenges because of the US-Iran war, things were not quite as expected, inflationary expectations went up, dollar strengthened, Kevin Walsh sounded more hawkish than ever. These are near-term issues. We are investors for the long term. And to my worthy opponents, no one is saying your asset class is not good. It's just that, can you sleep at night? How many of you in this room have not had a good night's sleep for the past few months? Hands up.
That's because of the World Cup.
Because of World Cup.
Of course.
Because of Trump. There are so many reasons. But you are also worried that tomorrow morning you wake up, you see some huge volatility in the equity markets, AI stocks down 10 to 12%. But for gold, you know, you need the steady eddy in the portfolio. Not unlike bonds, I must agree. But certainly we do need an allocation from a strategic point of view. Now let's talk about the smart money. We were worried, for example, this year when some countries, due to the fact that they had to support their currencies, were selling their reserves and central banks in some emerging markets. Is that going to continue? Well, the World Gold Council went out to central banks and did a survey just very recently, published last week. And guess what? Their commitment remains strong. Central banks around the world said 89% of them said that gold reserves will increase as a share of their reserves. 45% of them said, well, their own intention is to increase their gold reserves. Why is that? There is a structural concern over US dollar. There's a structural concern over the fiscal sustainability of the US. Therefore, unlike the reserve mix that is very skewed towards US treasuries, there is an intention by many to now diversify more and more towards gold, which one can consider as a non-sovereign currency as well. Now, the other very important thing that the survey showed was also that central banks not just want to allocate to gold, they're also interested in gold custodized in various countries. Case in point, whether they're custodized in their own home country, in Singapore, and in other locations. This really goes to show that the role of gold is to serve not just the individual as an investor, but even sovereigns around the world so that countries can stay and sleep at night. So therefore, my ladies and gentlemen, I would like to put to you that the question of today is what is the most investable asset for the second half? And with the correction, it gives you an excellent entry level. So this is my case for gold. Thank you.
All right, ladies and gentlemen, now it is your turn. Can I have the QR code to be flashed out? I would like to invite all of you to scan the QR code, and after hearing the first round, you will be voting which asset class do you find most compelling for the second half of 2026.
Are people on stage allowed to vote as
Unbelievable
well?
that you stole my wedding vows.
Can we jump
That's
to the screen
remarkable.
and look at it in live? You can still scan, the QR is still on the screen. This is just round one, right? We want to gauge the temperature. After that, we have round two and round three. Who knows, perhaps Ennis will take off his glove and he will start fighting. And then we will see at the end of the show whether it will change. Let us look at the result.
You have to vote with your heart, in your hearts of hearts.
There's no influencing people once the voting is started. Yeah?
Wow,
This
Alexis,
is
I
politics.
didn't
Anything
believe that you
goes.
actually
Anything
get 27 votes. I thought you at most get like 5 or something like that, but it's quite balanced. This looks like a portfolio already. Come on, guys, we have 200 responded so far. Those of you
Come on,
online,
guys.
if you're watching us, you can also scan. In the chat box is the QR, and you can also vote for your favorite asset class for the second half.
Or favorite asset class representative. Important.
Let's not make this personal, okay?
Oh, gosh.
All right. I think we have the poll, right? We can see on the screen, Stefan. I think the market is just on your side. Right? I think we can just put a rock here and you will still win. Because right now, you have the most votes. But what is very surprising is that Asia, fixed income and alternatives, we all have very, very similar votes, which means people do, like different asset class. But we will now go to round 2 and we'll try to see if we can sway them over, right? We will see if things will change. Now, round 2, I will be throwing a challenge question for each speaker, and we will still start from Stefan. You are already the winner here, but I just want to be really, really, I don't want to be easy on you. I just want to say that for global equities, whether we look at the S&P 500 or NASDAQ, we can see that there are a handful of mega caps. They are just dominating the entire index. So if today I put money in global assets, which many funds are just pouring it to S&P 500, am I just betting on very narrow market leadership? Stefan?
First of all, I would congratulate the room. I think that we get such a diverse picture in votes really speaks to the quality of the participants today. Here, you as voters, that you really look at multiple asset classes and have not already set your mind just on one thing. So just as an aside note. If I break down maybe your questions into 2 parts, I think there's usually now 2 concerns that people have about global equities. Concern 1 is, hasn't everything gotten terribly expensive now? Concern number 2, isn't it very concentrated? I'm just buying 3-4 companies, and if there's concern about these companies, everything will collapse. So I want to address these kind of points separately. First of all, on valuation. I think that perception is a bit skewed by social media or also by the news media, because there's focus on a very certain set of metrics and also on certain prominent companies. No doubt, SpaceX, for example, is very ambitiously valued. Maybe valuation should be a concern for such a company. But we need to look at broader markets. And in a market environment where we are now, where we really have once in a decade or once in 30 years kind of shift in technology, where we have a lot of earnings momentum, I think lots of these valuation metrics are kind of skewed. And just to use one slide here, or one number only, this shows the valuation based on the expected earnings. So what are we expecting for the next 12 months in earnings to come? And just in the bottom left, maybe, okay, this doesn't work. Oh, sorry, it does work. Just in the bottom left here, I want to focus on the S&P only, because that always gets picked up. The number is 57. And that says, compared to the last 5 years, actually, currently, the US is only in the 57th percentile, so roughly average valuation compared to recent history. So valuation in some pockets of the markets can be a concern, but I think for the broader market, we can be somewhat more relaxed about it. Second is the concentration factor. And here I would focus only on the chart on the left. That shows how earnings expectations go up or down for certain regions. If the numbers are above the 1, it shows in general people get more optimistic about the earnings in that region. And that is not market capitalization weighted, but just the number of companies. And we see all these numbers are going up in all the regions. So for most of the companies, in most of the regions, people are expecting improving earnings. And for me, that speaks more that we are looking at this broadening out. I also mentioned it earlier for the AI, that the next phase will be a broadening out. And I think already now, when we look at the earnings, when we look at the earnings expectations, I think this broadening out will be one of the major themes for 2026, maybe even beyond. Even though, of course, the last year or so, maybe the growth has been a bit more narrow. So to summarize, point 1, valuations stretched in some pockets of the market, but not necessarily for the broader market, certainly not globally. And point two, are we too concentrated? If we look at the 12 months, perhaps yes. But if we look at the kind of leading indicators that we have for the second half of 2026, for 2027, I think we do see this broadening out. And so I would say valid concerns about the past, but for the future, for global equities, I think we can be fine.
Thank you, Stefan. My second challenge question is to Anis.
Yep.
Anis,
Yep.
if Asia is so attractive, why hasn't it consistently outperformed?
Okay. Bit of a loaded question, but here we go. So, if you look at the drag to Asia Pacific, I would say there are two big reasons. Biggest elephant in the room is going to be Chinese equities. This has been the major drag to broader Asia Pacific markets over the last couple of years. And the second has been the relative strength of the US dollar up until this year. If you take these two things aside, we've had some of the best performing equity markets in the world, in India, in Korea, and in Taiwan in this region as well. So I would say there's a bit of a misnomer, and you have to dig a little bit into the details. So let's go back to these two things. I think number one, we've already seen, I think there's common consensus around the world now that the US dollar is relatively overvalued, right? And we are expecting over the next 10 years that the US dollar is going to structurally have a bit of a depreciation over the next coming years. It's not going to be a straight line, but the trajectory and the distance of travel is very, very clear. The second thing is on China. If you guys remember, in the late 2024, the Chinese government basically put a put on the market, right? They came up with a number of stimulus measures to basically try to slow down the decline of prices in Chinese residential properties and try to stimulate Chinese consumption, for instance. If you look at the performance of Asia-Pacific stock markets last year, China was up 30%, Korea was up over 100%, and sort of Taiwan was up 40%. So I think broadly speaking, we've seen basically a change and the recovery in Asia-Pacific equity starting last year, and that momentum continues into this year as well. So all of that being said, I would say Asia-Pacific is now in a much, much better place. The difference this time around is what's changed. And I think this is not necessarily a very particularly sexy topic to talk on stage, but the idea of shareholder returns being front and center for the first time in a very, very long time on a consolidated basis across the region, this is a really big game changer. Japan started this many, many years ago, but we saw value-up programs in Korea, we saw the EQDP program out of Singapore, China is doing their own version of shareholder reform, and a couple of weeks ago, Malaysia just announced their own version of value-up as well. All of this is to say that there's going to be much, much more emphasis placed on shareholder returns, whether that be through dividends, income theme, or buybacks as well. So I would say all of this adds up to a really interesting story where you're getting growth at a fraction of the valuation. You're getting income with certain tools. You can get that number up to close to double digits. Right? And finally, you're getting this massive, massive structural wave of shareholder reform. So there's a lot of things changing. So I don't think Asia is in the same place it was about 5 years ago.
Thank you, Anis. I asked him about the past, but his answer was basically, forget about the past, focus on the future because it's getting different.
You can't make money from the past, you can make money in the future.
You can't make money from the past, I like that. All right, my third challenge is to Alexis. Alexis, I don't think I'm being fair to you. My question is a bit technical and maybe a little bit too aggressive, but I'm going to ask you anyway. If rates stay high for longer, aren't returns for fixed income capped while still exposing investor to duration risk?
So, am I correct in understanding that you're asking me whether fixed income is going to return fixed returns? Is this the question? All right. In all seriousness, this is a real concern for investors. The main concern is what you see on the right-hand side of this chart, is that most clients, I'm afraid here, have been looking at bonds and at their fixed income portfolio through the prism of our most beloved index, the global aggregate. It's a terrible index. Generally, in fixed income, indices are horrendous because you're basically favoring companies and government that are issuing the most debt, which is not generally how you would want to do things. So this is why I think the name of the game, particularly right now, we are entering an era where being active in fixed income is absolutely crucial. And you said something very important here. You talked about duration risk. What most clients fail to realize is that those indices, whether the global aggregate, the US aggregate, you're essentially taking exclusively interest rate risk. And guess what? That risk hasn't gone particularly well, in whether due to inflation, whether due to rising rates, and we definitely see the market being a bit in a post-traumatic stress disorder from the 2022 inflation that we had. So what do you need to do? You need to diversify. And you probably don't appreciate all of the opportunities that we have. But if you take, for example, a multi-sector approach, which is the bar chart that you see on the left here, the very colored one, you have to go and look for opportunities where they are. We don't think that allocating in government bonds or in corporate bonds is a great idea at the moment, because again, we think that this is where, as you rightly pointed out, all of the risk is and none of the return is. That's the chart on the right shows you the return, the risk and the volatility and the return over the past 5 years. You didn't make any money in those indices, but in multi-sector approach you did. And this is because we're able to go and tap in opportunities within securitized credits, agency mortgage-backed securities, CLOs, MBS, all those asset classes that sounds very esoterical, but that are actually the only place in fixed income where you get good yield, good defense, and more importantly, where you're diversifying away from duration risk. So for all of those reasons, this is where we're very bullish. In all seriousness, this is where we as a firm, we've been investing a lot of resource and efforts in the recent years, and we have a tremendous expertise. You need to be thinking active when you think fixed income, and more importantly, diversify away from your big benchmarks, because this is the trap that we're facing right now. And there are a lot of opportunities in fixed income, but you have to go and dig under the surface, and you need somebody to help you do that. So obviously, I think we're the best at doing this. Prove me wrong. And in the meantime, I just demonstrated that just like in politics, you've given me a question, and I've given you my answer, which has nothing to do with the initial topic.
Thank you, Alexis. It's very intense from my view here, because I can see that Jean is actually, she's holding a pen and she was just taking notes. When her competitors are speaking, just like a high school debate like that, you know, they're just writing and writing. So to Jean, also not an easy question. Gold has no yield, and prices are already high. Isn't gold simply a fear trade with limited upside? That is the question.
Thank you very much. The reason I was writing notes is that in every asset class that you have talked about so far, global equities, Asian equities, and fixed income, notice that the question was on risk. So the question is there risk right now across the asset classes? The answer is absolutely yes. Valuations could be a risk, tail risk in terms of what the interest rate environment could be, in terms of potential hikes in interest rates and hence duration risk. And of course, Asia, we are also seeing concentration risk, particularly in the semiconductor stocks. And therefore, as investors, we all know that gold has a special role to play in the face of risk. In the chart behind me, we've seen that, yes, gold was not the top performing asset class in every scenario. Of course not. Neither are any of the portfolios. But what gold's role is to play that duality between the fact that certain asset class could be prone to volatility in the short run. No matter how positive we are, we cannot deny that there will be bouts of volatility. And gold is just that special asset class that is able to be the foil, the hedge against potential uncertainties. But now we all know that uncertainty is become a base case in every scenario that we know. Therefore, I do agree with you that yes, gold has no yield. But gold is a bit like insurance. You have to pay for it. Yes, it doesn't pay you in the short run, But on the days that you need it, you are so glad you paid for it. And that is the role that gold has. Now, on a structural basis, gold now has a different role from the fact that on many levels, sovereigns and countries around the world are facing a lot of challenges on the fiscal front. Even in Europe, as they increase defense spending, there's going to be a burden on the fiscal situation. Across Asia, we have aging populations that potentially with a higher fiscal burden and a smaller tax-paying population, there will be fiscal stress from time to time in various currencies. And that is when domestic investors are increasingly wanting to diversify away from their home currency and potentially the US dollar, which has structural issues, into gold as their alternative third currency in their portfolios. And therefore, I would like to say that thank you very much, my worthy opponents. All of you have been building up to the point that I wish to make, which is, if you think there's risk, you need to have gold. Thank you.
Thank you, Jean. I will now screen through the questions that is being pumped in, and I'll be asking the 4 speakers in the same order, and for each question, they only have 90 seconds to respond. Before I do this...
Where's the whistle?
This is not football.
Very stressful there, Andrew.
90 seconds only. There will be no slides. It will be a quick fire round. So my first question here for Stefan is, with the AI investment cycle requiring massive capital expenditure, how should investors assess, right? Sometimes when they put in a lot of money, but they are not able to instantly monetize it, and that would reflect in corporate earnings. And that will be some sort of a risk, will the certain shares of certain big companies come down because of that? Stefan?
What was the question?
Yeah.
How to position in that kind of environment?
The question is the risks.
The risk.
The risk of corporate pumping a lot of money into AI infrastructure, but it takes time to monetize it.
Right. Yes, I think that's one of the primary concerns, especially if we look at the hyperscalers, really putting hundreds of billions of dollars into that kind of infrastructure investment with an uncertain path to monetization, really. And to that, I would maybe have 2 arguments why people can be a bit more relaxed about it. Argument 1 is, I think the market is already quite smart about it. So if we look at the latest announcements of new investment plans for these big companies, often actually it has not been so well received by the market. Equity markets often have reacted more negatively. And that is a big change in market sentiment compared to 1 or 2 years ago, where the bigger the spending plan, the more excited investors got. But now, because there's this feedback loop, I think companies will moderate their expenditures for the one hand, and on the other hand, also the probability of just like a sudden big bust, I think is also declining because markets are already starting to price it in. On the second positive side is that we do see AI spending actually going up, not by the big hyperscalers, but by all the companies, by consumers. No matter what segment you look at, everyone is actually starting to pay for the AI, to putting in those subscriptions and making that kind of just a normal part of their business expense. So that question, can it even be monetized? Are people not going to use it for free? That now we can already answer, yes, people are willing to pay for the latest models to get an edge in their competition, to drive their business forward. And that, I think, is a big change compared to a few years ago. So yes, I think it was a risk, but I think it's getting mitigated as we go along.
Thanks, Stephen. The second question, and very quickly, let me just paraphrase, is if investor wants to invest in global equities, but they do not want it to be very concentrated in just a few AI stocks, how should they diversify across sector? What is your recommendation?
Yes, on that I would say you should maybe adopt a core satellite approach. I think you should have a solid core, try to invest in globally diversified equities. And then beyond that, I think you can make a certain selection of sectors you like in particular, but then in terms of risk contribution, they will be more measured to your total portfolio. So even COSPI goes down 15% or so, it doesn't drag down your total portfolio, but it's only like one of your satellites that gets kind of impacted. To get a bit more specific, I mean, I still do like tech. In the broader sense, I mentioned robotics earlier, which I like. AI is consuming a lot of energy, so actually I do also like the energy sector, in particular a bit in the clean energy space. I think that has a lot of promise, and then also going through kind of the AI chain. And then a bit more maybe on the short-term tactical side of things, we did see a lot of adverse market impact with the war in Iran. Now that risk seems to be somewhat declining, so I think we can also look at some recovery trade in some of the most hit areas. So I do think some pockets of Asia have recovery potential. I think also in Europe there may be some value, let's say, for the next half year or so. So that's also might be worth considering as part of your satellite allocations.
Thank you, Stefan. And now to Anis very quickly. Anis, the first question is, last week we just saw South Korea's KOSPI suffer a massive 10% single-day sell-off, exposing how vulnerable Asian equity is. So the question is, if the region's top-performing market can experience such volatilities, how can we trust it long-term?
Sell everything.
I know, that's a really tough one. Okay, so let's put everything into context, right? South Korea generated 100% returns last year. And the first 6 months of this year, they did another 100% returns. First of all, that's quite a lot of money. Secondly, the challenge, I think, right now is obviously investors are reacting to a lot of news flow, and I think right now, when we see consolidation, we're looking at this more of as a consolidation in markets than any big structural issue. If you look at the big drivers, right, we have Hynix and Samsung. Combined, they're about 50% of the market. So, you know, we are friends in industry, in market concentration to a certain degree. But you have to understand that at this particular point in time, like I mentioned in the beginning, for every $100 that comes in that hyperscalers spend on AI, 70% of it comes here in terms of hardware build-out. Between TSMC, Hynix, and Samsung, there really is very, very little competition that they can do. Now, the concern with sort of the sustainability of this is whether or not the chips and memory is still a cyclical issue or is it a structural issue? Meaning, is the AI demand going to slow down tomorrow and all this inventory that we build out is going to go away and we're just going to be stuck with so much stuff? I think the answer is not yet. You have to look as well, and this is getting very technical, but in memory, right? Let's think about the chips. What powers AI? The reason why we always talk about Taiwan and Korea is when you think about AI, you need stuff that thinks and you need stuff that remembers what it was thinking, right? The stuff that thinks, this is the stuff that TSMC makes. And the stuff that remembers what it's thinking, this is all the memory. Within memory, there's stuff that is very AI-linked. This is what we call high bandwidth memory. This is where the demand right now is substantial, and we don't see massive corrections. The commoditized plays, that's where we get a little bit worried that this could really turn. So to answer your question, it is a consolidation that we're seeing in the market right now. We're not necessarily seeing any big structural shifts yet, but yes, there are worries, so you must be active. You must be ready to rebalance your portfolio very, very quickly. But that's not the only game in town.
Thanks, Anis. I think you just give Jean another point to ask people to invest more on gold just to balance off the risk. She is just writing it down, you know. Thank you very much, Anis. Second question to you very quickly. In Asia, you know, we always have this currency challenge, right? Mm-hmm. Some, like for example, Indonesia, certain countries, it's very volatile. So will that affect, you know, our clients' investment? How should they view it? You know, will it affect the growth of Asia?
Yeah, so I would say one thing, and again, I've been talking about income a lot, right? Now, one of the things that currency adds is volatility. What it doesn't add is income or returns. So for the most part, for investors who are investing anything that is offshore, that is not ringgit denominated, and if you don't like that currency piece, hedge it. Number one, hedge it. Then it's all gone. right? But the second thing, on to your point around currency risk, that is the number one thing that we always think about as well, when we're investing. That comes when we're trying to do our due diligence on the companies and the stock selection. We have to price in the currency when we're trying to establish what is the fair value of a company. So a lot of that research is already baked in on our end. But to your question about Indonesia, sadly, unfortunately, ASEAN is not really a big part of the index that we're looking at this point, so it won't necessarily materially impact. But going back to my original point, the US dollar is a very, very big driver for Asian equity market returns. There's a very strong correlation or relationship between Asian market performance and the strength or weakness of the dollar. And if we do see that the US dollar will weaken over time, this will be beneficial for Asian markets, especially Asian corporates who have to raise money overseas as well.
Thank you, Anis. Next, my French friend, Alexis. Alexis, when I look at the question, unfortunately, I only have one question on fixed income, so I'll add another one for you, and you can answer two of them one shot, all right? The first question is, in your view, do you think France will win the World Cup?
Yes.
And why?
Because we're the best.
That is the first question. You have to think about the why, right? And the second question, when it comes to long-term inflation, how should we structure our fixed income portfolios to counter that?
Yeah. So first bit, France will win. Why? Pretty obvious. Mbappé, Dembélé, do I really need to make your picture? We're going to make it. Don't worry about it. So, sorry, obviously, Stéphane, I'm sure you think differently, but you used all your time to talk about equities, and I'm using my time to talk about football.
Beginner's mistake on my part.
Coming to fixed income, I think exactly to your point, the main concern so far this year and the main driver of fixed income returns has been about rate risk. And the main driver of rate risk has been linked to inflation. Really, what we saw with the Strait of Hormuz closure, immediately how the market reacted was, oh, the Strait of Hormuz closure means higher oil price, and so this is higher inflation. That was very scary. Bond sold off. Even though technically you could have also thought, hey, higher oil price, hence lower general productivity and growth, hence probably good to be risk off and have bonds. So the focus is squarely on inflation. And this is precisely why, in the chart that I was showing earlier, was a little bit busy, I grant you that, our focus has been on floating rate instruments. This is where we see a lot of values. Things like collateralized loan obligations, CLOs, ABS, asset-backed securities. Those are floating rate instruments. When the rates move, those asset classes are almost unimpacted. And that's exactly what we had this year in March, where CLOs were the largest CLO ETF provider in the world. That performed very, very nicely. Similarly, last year during Liberation Day, we had a bit of a similar story. So in a nutshell, our advice would be stay as close as you can to the short end of the curve. It means use active short duration strategies, possibly floating rate instruments if you can, and more likely than not, you will need to be helped by an active manager to achieve that, because it's quite difficult as an investor to just do it on your own. But those are definitely the pockets of opportunities that we see where you're not being compensated to take duration risk, you're compensated for taking spread risk right now, and we think floating rate instruments are the best way of doing that.
Thanks. Let me just sum up his reply. Basically, he's just saying stay to the shorter end when it comes to duration, and secondly, engage OCBC to continue to update you
precisely
on the market. Thank you very much. And lastly, I must ask Jean, before we go to our second round of voting, I hope there will be a change of mind, but Jean, this is not too difficult. I filter off the difficult ones. For gold, right, Jean, other than serving as a hedge against inflation and probably currency depreciation, what other factors could drive demand for gold?
Well, I think gold has traditionally been, for many economies, including in Asia, not just a source of portfolio diversification, but certainly there's always seasonal demand in India as well. right, from the gold wedding season, if you like. So gold has always has a special place in the hearts of many Asian families as Asian companies as well. So this year, one of the drags on gold has been the fact that India actually increased the import tariffs on gold, and that has been one of the dampeners for gold price. So if that should be lifted or that should be adjusted in any way, that will be one of the catalysts for gold as well. Now, what other sources of demand? I think generally now, I think as I mentioned, central banks do see gold as a very special allocation within their portfolios. Now, the question is whether that also becomes the norm, not just of pension funds and central banks, but also for individual families, multinational family offices that now have the ability to allocate capital in a much more deliberate way and also in much larger sizes. That's certainly one of the areas that we see potentially incremental demand. For example, we see Chinese families also building out bigger portfolios that are well diversified, not just by asset classes, but also by countries and locations. So I certainly see that as the wealth management industry grows around the world, that is also another incremental source of demand for gold.
Thanks, Jean. Last question before we vote again. With increasing competition from other store of value assets, like digital assets, for example, will gold lose its relevance?
Well, we've seen the volatility in digital assets, particularly cryptocurrencies. So yes, it is a contender, and I don't rule out the fact that in generations to come, potentially digital currencies could start to also take some place in the portfolios. Today, I see it as optionality, but frankly, the volatility is just way too high for it to qualify as a hedge. If anything, yes, it is a diversifier. Yes, it is a potential. New use cases could start to be used for digital currencies. So I don't rule that out, but here and now, I think it still does not take the place of gold, particularly for what I mentioned, store of value, central bank diversification. Today, it's still a niche asset class, but could gather momentum over the years to come.
Thanks, Jean. And you have heard from all our 4 speakers today. Can we flash to the QR again? We would like to invite you to vote one last time after hearing from them for 3 rounds, 8 questions. Did we manage to change your mind? Please whip up your phone, and we'll give it a minute before we go to the results. Alexis will see, how charming you are if you manage to sway them over.
I think the football will. And I also noted I'm the only one who had only one question, which shows that I've explained it so well.
Wow.
That no questions were needed.
You're at 21 votes. You're not winning now, Alexis. Come on, guys. Please help Alexis. Anis is doing well. Asia equities has actually bumped up.
I think it was the 100% last year, 100% this year.
All right, more than 262 has responded. Those online, if you're dialing in, also do vote. Look, oh my God, JP Morgan Asset Management.
Again, you can't invest in the past. I'm just going to sort of caveat that now.
The global equities is still high, but I think people are a little bit convinced more about on Asia equities now. Alexis is still Alexis. And of course, gold, we still have supporters for gold. You see, Alexis, you and Jean actually have the same vote, but I'm just narrating this very differently.
I know. Just remember, it's slow and steady wins the race. It's tomorrow, Korea market could be down 50%. Who knows?
Okay, we've got
with
India,
all of those
we've got Taiwan,
all of those
China.
leveraged single stock ETFs.
I'm telling you, Alexis, if I did not invite you, bond will have 0.
I know. I know.
Right, and I will have a hard time to explain to my bosses why nobody vote for fixed income. Did you ask a lousy speaker? No, but you are here.
Yeah.
All right, I think we have more or less, regarded the response for from the crowd today. And I'm very, very pleased to say that after the round 2 and round 3, something has changed, right? We have managed to convince you, or we have managed to convey to you the message that, having a portfolio matters a lot. And of course, you understand, right, the message that we are trying to drive with all the 4 speakers here. You all can be friends again, all right? Happy to partner with you all. But we still need to drive the message home. Right? And I do not think I'm the best person on stage to drive that message home on portfolio construction, on how we should balance, right, our assets when it comes to which part of the world, which equity, which fixed income, whether we should invest in gold. I think Jean will be the better person to explain that. So just to wrap it up, just to give everybody a summary, Jean, would you care to share with us, right, your views on how to construct a portfolio and how should our clients balance up?
Thank you very much. First of all, I'd like to give a round of applause to my fellow speakers. And in case you think I'm a gold bug only, please be aware that this was a characterization for the good fun that we have on stage. And clearly, what we've characterized this morning as a horse race is not the case at all, right? In our portfolios, we're not competing amongst ourselves for which asset class is going to outperform this year and next. And in fact, that is also very foolhardy if you think about it from the beginning of the year, because you are not in this business of trying to win one asset class over the other. What you really want to do is to ensure that your objectives, which is a long-term, resilient portfolio that can withstand the volatility of today, the cycles of tomorrow, and the structural changes that we're seeing all around the world with the AI revolution, that your portfolio remains strong, resilient, generates return year in, year out, come what may. And that is a team sport. So if you imagine the 4 of us on the pitch right now, we would see some strikers, a goalkeeper, as well as defense, and we would be playing our roles at different times in different places, depending on who our opponent is, whether it is geopolitical risks, or is it macroeconomic risks, is it technological change, is it country risk. Depending on the scenarios, each of the asset classes will play different roles in our portfolios. Which is why at Bank of Singapore, at OCBC Group, Wealth Management, we believe very, very strongly that diversification is the key. And the bedrocks of investments don't change, regardless of whatever asset class. What are the fundamentals? What are the valuations, the technicals, and the risks that we need to manage day in and day out? And that's the job of the investment advisory teams, as well as our RMs and CAs here in the room, to really watch out for you on every corner of what could come next. Now, how do we really see the second half of this year? We think that indeed we have had a very strong first half, notwithstanding the fact that we is still in the midst of a war. Now, we saw the oil price start the year at close to $60, go all the way at 120, and now we're back at 70. It's as if nothing had really happened, but all of us know that much has happened in between. We've seen semiconductor stocks rage away. Now, is that prognosis for the second half? Now, we are very encouraged by the earnings picture, and therefore we are also overweight equities as a house, and in particular, we're overweight US equities with a bias, of course, to technologies as well as growth sectors. However, we're very conscious of the fact that concentration could be the sting in the tail. So we do believe that as investors, you do need to be very involved in the equities market. However, with diversified portfolios, using style managers like the ones on the stage, as well as a very diversified exposure to different sectors, and not just what's trendy and not just what's gone up. Because we also know that there is going to be a wide dispersion in terms of the winners and losers from this AI revolution. Now for Asia, absolutely, we're also favor Asia. And we, if you recall, actually upgraded Asia ex-Japan as early as 2024. We had a good ride, and Q1 of this year, we actually pared down some of our bets. But at the same time, we do believe that Asia has strong drivers going ahead. Now, case in point, China. Yes, it's true that China has probably disappointed some of us, But let's not forget that China is in a period of renaissance. We do see that some very important macro drivers are beginning to shift. And from a technological standpoint, China is going to have its stamp on the AI technology change. And we do want to be positioned for the potential that China could start to outperform again. So again, do look at your Asia exposures. Look at the strategies that we have to broaden out your exposures as well. Now, fixed income. It is not away from the sun at all. Fixed income is a very important part of our portfolios in terms of generating income. From an all-in yields perspective, fixed income does give us very strong returns. And from a risk-adjusted basis, we just need to be very, very cautious on duration management, as well as monitoring the credit quality. Now, we at Bank of Singapore believe in an approach that we call the whole portfolio approach. Why is that so? We don't think that this world is now so simple that we have just bonds in one bucket, equities in one bucket, gold and alternatives, etc. Instead, we do think that we're starting to see companies actually be exposed to all areas. Take AI, for instance. AIs are not just the hyperscalers, not just the semiconductor stocks. The exposure now also means some of these are in our investment-grade portfolios because AI and as well as hyperscalers are becoming big issuers. So even as you invest across the board, just be conscious of where your overall exposure to tech is and look at solutions that potentially can help to diversify your overall AI exposure as well. Now here in Asia, Southeast Asia, we're actually enjoying a very interesting environment now with this AI boom. Now both in Singapore as well as Malaysia, we certainly see some huge opportunities on the infrastructure front, especially with the data center, hunger for power, hunger for capacity. Now, both in Singapore, Johor, and Riau Islands, we're seeing a renaissance as well in our region to great investments from US as well as large semiconductor players in our area of interest. So I'm very optimistic as well that Southeast Asia and Asia does have legs in terms of Asian exposure. Now, so we do encourage you, again, the second half is not going to be so easy, but the general picture does look relatively benign. Apart from the fact that we do see a tail risk on the inflation front, we cannot deny that PCE and CPI numbers will continue to trend higher. Kevin Walsh and central bankers all around the world, the Fed as well as ECB, Bank of England, will tend towards the hawkish side of things. So interest rate volatility is here to stay. But that's not something to fear. Lean into risk, manage risk. Now, so just to close, I will close with the 3 A's that I hope you remember as our key themes for the second half. AI is here to stay. It's in anything, everywhere, and happening all at once. There's good and the bad and the ugly. So let's invest wisely. Second, Asia continues to be a focus. However, we also see dispersion in Asian countries and companies. And so again, quality remains of key interest. And finally, asset allocation. That is the key to being exposed to growth drivers, managing risk, and giving you a very resilient portfolio, not just for this year, but for 2027 and the years to come. Thank you very much.
And that's all the time we have. I want to thank Stefan, Anis, Alexis, and Jean. Thank you all for joining us. This is OCBC Wealth Insights.